Cathy, there's a lot of talk about BlackRock potentially buying Aligned data centers. I believe the deal is, at least the rumors are 40 billion. And then also AES, is it, for 38 billion. What does this mean? Where are they going? Because this is almost a $100 billion investment if this comes true.
Well, I mean, I really don't want to speculate on who they might buy, but I think it's important to consider that within the context of what they have been doing. And, BlackRock has this goal of expanding beyond just being a sort of bread and butter asset manager. And they've already done a lot to branch out into other areas. And, they've got their Aladdin business, which is technology. And that's a little bit of a misnomer. It's a broad suite of products aiming to serve the insurance and the asset management industry. And they've also expanded into alternative assets. But in terms of data, I mean, they've also been making acquisitions in that space. They bought Preqin, which is a significant supplier of data to the alternative asset management industry. So I wouldn't be surprised. I don't really want to speculate, but, they do have a goal of having their revenue stream, 30% of their revenue stream coming from alternatives and data and technology. And an acquisition like that could definitely accelerate that plan.
We keep hearing a lot, and this might not be relevant specifically to BlackRock, but this discussion right now that's in mainstream linear media about an AI bubble. Powering whatever AI survives, which of course it will, whether there's a bubble or not, is key. Does an AI bubble deflating have any impact on these deals? Would it lower the value of these deals, or will they actually continue to go higher?
I think the AI bubble is sparking a growing shift in some of the asset management ecosystems. And we've seen it with a number of deals across the space. I'm not an AI analyst, but I don't necessarily think that I think the AI story has got more room to run. I think it's going to be more of a bifurcating factor than it necessarily is a threat of a bubble. And I think right now it's still somewhat of an arms race. So I think the bigger concern within the asset management space is more of who's getting or who's acquiring these capabilities to be able to address both the opportunities and the threats from AI, as opposed to an AI bubble. Does that make sense?
It does make sense. And at the end of this, I want to ask you what you're looking to hear from Larry Fink in regards to AI and the billions they might be prepared to spend as they move into different aspects of the space to generate profits. But I want to get to what happened in Q2 with KBW, because it was a lower quality beat on their earnings, according to KPW. They leaned in on non-operating income while adjusted operating margin lagged. So what is core versus market sensitive in that line, and what's a clean run rate for it?
I think it's important to look at, if you drill down and, despite the fact that they are evolving into these other businesses, at their core, they're an asset manager. And I think if you want to bottom line this, look at organic AUM growth, because their peer group is the alternative asset management space, and they have had a tough year, and the shares of a lot of alternative asset managers reflect that. The expectation is a lower interest rate environment will give them back their tailwind. But then you have at the other end of the spectrum some of the traditional active only asset managers who continue to bleed assets. And I kind of view BlackRock sort of positioned right in the middle of those two, and also in the midst of evolving into more of an alternative asset manager with this other technology arm. So I don't necessarily think that the quarter was not a high quality quarter. I mean, look, growth is growth. And if you're getting growth because you're bringing assets in the door, that's certainly a higher quality rate of growth than an asset manager whose AUM is growing only because you've got a market tailwind. So I think it's important to look at organic versus inorganic growth. Now, against that backdrop, BlackRock is going to have some inorganic growth because they're going to start seeing the benefits from these acquisitions. So, there is that, but that's also part of what I believe is a well-articulated, seemingly at this juncture, well-executed strategy.
I want to switch to crypto and Bitcoin because a colleague of mine wanted me to ask you, why should they file a Bitcoin premium income ETF now? And what problem will it solve for, especially as their existing ETF, Bitcoin ETF is about to approach, what is it, $100 billion? So what is the goal here? And then how does the strategy generate distributable premium? And who is the target client?
I think when you have, when you're the largest ETF provider, it's difficult to move the needle. So I don't necessarily think rolling out a crypto ETF or pushing for alternative assets in 401ks is necessarily going to move the needle for a company like BlackRock. I think it's more a function of remaining relevant and offering a suite of products that are in demand. I don't necessarily think a crypto ETF is going to move the needle for them, but again, it allows them to remain relevant and to offer a suite of products that reflect what's going on in the marketplace.
All right. So what's the single biggest risk to, the BlackRock thesis over the next 12 months? And what early warning metric are you going to be watching out for that risk?
I think the biggest metric is because they're so economically sensitive. I think the biggest metric or the biggest potential risk to the story is a broad-based global economic downturn, because that's going to reduce the demand across the board. I mean, I think honestly that's the biggest risk right now. As they continue to diversify into other assets, there is also geopolitical risk that sort of infiltrates their business model with the global infrastructure's partner deal. But, that's a risk that is inherent in a lot of their alternative asset peers. So again, I think the big risk is a global macro risk, and they're certainly not alone in that risk.
What are you looking to hear from Larry Fink, from the C-suite when they do?
I want to hear an update on the strategy. I think they did a good job outlining the strategy. I think that, honestly, I think that the deals that they've made set them up nicely to evolve into a more diversified asset manager with varied revenue streams. I'd like to hear an update on that. But honestly, I think people are really going to be looking for, number one, top line growth. They have peers in the asset management industry that are going to show very little top line growth because they bleed assets. So the ability to generate double digit, even if it's low double digit top line growth, is definitely a factor and something we'll be looking for. To your earlier point about quality of earnings, I think the degree to which earnings come from organic asset, AUM growth is a positive thing. And I think just a general tone of what he sees in the broader landscape. He has a purview unmatched by most people, and there's a lot that he could share with us, particularly given all of the geopolitical uncertainty out there.
And this is a very self-centered question as I wrap up with you, but I love New York City. I moved here without a job a billion years ago. There's this talk about firms like BlackRock and the big leaders in the financial industry moving to Texas. BlackRock has huge operation in Texas. Is this much ado about nothing, or do you pay attention to this? Do people in your world pay attention to this? Or, like I said, is it much ado about nothing?
They also have a presence in Florida because a number of their executives have homes down there. I think when these firms announce these moves, I remember when AllianceBernstein moved a lot of its operations to Nashville, everyone, had a similar reaction. A lot of the core team, the executive team, the money managers, they stayed in New York. So it tends to be the back office, operations, technology, which is certainly significant. And, we could have a whole other podcast on, the future of New York and New York office space and New York real estate. But, it's something a lot of firms do. They're lowering their overhead. New York is an expensive place to live and do business. So it's not surprising. I wouldn't necessarily call it much ado about nothing, but I think it's part of a bigger trend that a lot of other companies have done as well.